There is a lot of misguided and frankly bad content out there about what affects your credit score. That's why today we're going to be going over the 8 most common credit score myths. My name is Sean and I'm here with my co-host.
Hi everyone, I'm Sherwin. On today's episode of the Credit Card BS podcast, we're going to zoom through top 8 credit score myths. Now, we'll start with a disclaimer. Most of what we're going to be talking about is for more advanced credit card users that are focused on the rewards, loyalty kind of stuff with the credit cards. And these are people that are paying off their bills in full or not carrying balances. We strongly do not recommend carrying balances on credit cards in general because the interest rates are really terrible, especially in this country. So that's what we're going to be focused on. So with that disclaimer out of the way, Sean, why don't we give a quick recap of, what are the major factors that are put into a credit score when it's being calculated?
Yeah, so technically there are different credit scoring models, but for the most common scoring model, the FICO scoring model, the 35% of it is about payment history. Basically, are you paying off your cards? Pretty obvious. 30% is the amounts owed, so like your debt to income ratio. 10% is about the mix of credit, 15% is about how long your credit history is, and then 10% is about how much new credit you have within the short recent period of time.
All right, so Sean, why don't you kick us off with the first myth?
So the first myth is that you can't get a credit card without a credit score. This causes a lot of people to just hold off on getting credit cards forever because they think they can't get one. That makes no sense because if you couldn't get a credit card without a credit score and you need a credit card to build a credit score, you could never get a credit score. And that's what a lot of people think, actually. They think like, oh my God, how am I supposed to get a credit card?
Yes.
Because what people do is they go out and they're like, oh, I would like this super premium card. Oh, you don't have a credit score. You can't get it. What? People don't realize they need to start with a starter credit card, a basic level card, something like the Discover It or Discover Student It that you can get approved for even without any credit history, and then use that to start building your history. Since your age of credit history, honestly, even though it's only like technically 15% of your FICO score, it's a really, really important metric because it directly correlates with how much banks trust you.
Yes, I think student cards, as Sean mentioned, are really good if you're in college because they generally don't require like any credit history. And many of them actually have like pretty good rewards. So like, Discover has the 5%, cashback categories that, may not be significant later down the line when you're opening more premium cards, but it's really nice to have when it's just a starter card. I'm familiar that I think Capital One and what's the other one that US Bank also has student cards, I think, and not Citi.
Chase has like the kind of the Freedom, although it's pretty bad, right? The student version of the Freedom, they rebranded it or something.
Yeah, I think Capital One has the Saver One for students. That might be good. Has the 3% on restaurants and grocery. So, I mean, there are definitely options out there that you should look into. Now, if you're not a student, you could go for what is called a secured card if you have no credit. So, Sean, what's a secured card?
Basically, a secured card is you give a deposit to the bank, and then that deposit becomes your entire credit line for the card. So I give them $500, and now I have a credit card with a $500 limit. The bank takes on zero risk because if I don't pay the card back, they'll just keep my deposit, and then there won't be an issue. But eventually, when I show that I can pay off the card responsibly and build up enough of a history, the bank will refund my deposit so I don't end up losing anything. And then I've built credit history in the meantime.
Yes. So in summary, you can get a credit card without a credit score if you know what you're looking at. This does not mean you could just go out, apply for the Chase Sapphire Reserve, and expect to get approved immediately. No, like you do need to build it up. But usually what I recommend is start with a starter card, just have it open for a year, make purchases, pay them off. And then after a year, you can start going for the Chase cards because they do like to see at least 1 year of credit history. All right, let's move on to the second myth today, which is that opening too many cards will trash your credit score. Now, many people might not be aware that one of the factors of your credit score is how many accounts you have open. And it's actually the more accounts you have, paradoxically, the better your credit score is because banks generally see more accounts as a greater ability to manage those accounts and therefore better credit. Now, I want to be clear about something. When you open a card, it may temporarily lower your credit score. That is true because of the hard inquiry you take on with that credit application, as well as the temporary drop to your average age of accounts when that new card is open. For example, if you just had one card that was open that has been open for 5 years, and you just open a new card that is 0 years old, your average age of accounts would drop to 2.5. So you might see a decrease in your credit score. But assuming you're opening a bunch of cards like earlier on and they eventually age and grow your average age of accounts as well as number of accounts, your credit score will actually benefit from having a ton of cards. Sean, is there anything else you want to add about this?
No, I totally agree with that. That, people get afraid of opening all these cards because it's going to tank your credit score. But as you said, if you have like one card and then it's like 10 years old and then you finally decide to get another card, you just cut your average age of accounts in half. But let's say when you start getting into this game, you open cards more early on. Now, of course, leaving a relatively decent gap between each card to make sure you get approved for them. That's better because then you have this anchor in your average age of accounts that get really, really old. And so when you get more cards in the future, it doesn't hurt your credit score. I have I don't even know at this point, 27, 20. I've lost count of the amount of cards I have currently open because it is just getting, a lot. But guess what? My credit score has never been better. It's really, really strong because I actually pay off the cards. And that's really what the banks care about the most.
Yes, and actually, if you have more cards, you're more likely to have greater credit limits. And because utilization is calculated in a way where your credit limits are like the denominator at the fraction, the more credit limit you have and that you don't necessarily use all the time, the better your credit score is. So let's move on to the next myth. Sean, do you want to take this one?
So the third myth is that hard inquiries significantly hurt your credit score. And this is what also holds people back from opening a lot of cards. Like, I don't want to get all these inquiries because it's going to permanently damage my credit score. Not true. Now, in the short term, yeah, your score will, get hit by a little bit, but it's not really a big deal, to be honest, because one, most of the effects of that inquiry are gone within 6 months. Like, it's literally like your score basically just rebounds. And then after 2 years, they just disappear entirely from your report as if they never existed. So it's really not bad to have inquiries. Now, don't get 28 hard inquiries in one day, but a couple of them are totally fine as long as you're spacing them out and you're actually getting approved for the cards. That's what matters more. Not how many inquiries that you have. It's, did that inquiry result in something meaningful, such as a credit card approval?
Yes. So keep in mind in the FICO model, inquiries actually account for only 10% of the score, whereas other things like amounts owed and like credit history and payment history make up a much bigger chunk. So if that slight dip caused by the inquiry allows you to open an account that will eventually mature your age of accounts, increase your credit limit, and therefore decrease your utilization in the long term, it could actually benefit your credit score. As Sean mentioned, they drop off after 2 years. They don't even have that big of an impact to begin with. But I will say, do treat inquiries sort of seriously in the sense that don't random willy-nilly apply for cards that you're not really sure if you can get approved on. Like, you should have a reasonable probability of getting approved for a card before you take on that inquiry. Otherwise, it will be for naught. So just make sure it's worth it to kind of sort of take the risk inquiry if you think there's a reasonable probability you can get approved for the card and better your credit score in the long term, and also earn a bunch of rewards from that card. All right, I think that covers that pretty well. Let's move on to the next myth, which is that consistently maintaining low utilization is critical. So utilization in the FICO model is worth 30%, I believe. And how it's calculated is basically the numerator of the fraction is how much credit you're currently using, like what your balances are. And the denominator is how much credit line has been extended to you. And the lower this ratio, the better. So if you have 5,000 credit limit and you spent 4,500 on it, your utilization is 90%, and that's considered really bad. You'll see your credit score drop. But if you're spending $5,000 out of $100,000 of available credit, it's not going to be that big of an impact. Now, Sean, why do you think this focus on utilization is a little overhyped?
Yeah, so what happens is when any of these guides of how to increase your credit score will tell you, and they're not wrong in saying this, but maintain a low utilization because your score will go up. And that's true. But that doesn't mean you need to actually actively worry about it, because utilization is currently the only factor in the current FICO scoring model which does not have any memory beyond month to month. What I mean by memory is there's no history. So if one month I have 99% utilization and my score tanks and it drops 100 points, but next month I have 0%, my score rebounds exactly to what it would have been if I had 0% both months. It doesn't hurt your score in the long run at all to have high utilization. Once it goes back to 0, it will immediately jump back up to what it would have been. Now, the only time you really do need to worry about utilization is if you're like applying for a credit card, because if the banks are going to see your current score and you have a high utilization, then yes, that will be detrimental to your approval odds. However, if you're not going to be actively applying for any credit cards and, oh my God, I had this high utilization this month and my score went down 50 points, 100 points, doesn't matter. It like zero effect long term. It doesn't matter at all. So I think everyone gets obsessed like, oh my God, I got to keep my utilization down. I need big credit lines. I need $30,000 credit lines for my $300 a month expenses because I need to keep my utilization down. But no, it doesn't really matter. One, and two, utilization only gets reported if, for most of the banks, if like your statement closes with a high with the balance. So like if I had spent $500 on a $500 credit line card, and then that gets reported because my statement closes, then that shows up on the credit agencies. But if I just pay off the 500 like right after making the charge and right after the charge posts, that will not show up on my credit report. So you can spend as much as you need on a credit card, even if it's got a low limit, as long as you're just paying it off before the statement closes, and it won't even affect your utilization.
Yep, I think that's a very good point. Let's move on to the next myth, which is that business cards affect your personal credit. Now, there is an important distinction here I think you need to understand. So approval for business cards is often based on your personal credit. Like the decision as to whether an issuer will extend to you their business card product is going to be based on like a soft or hard pool of your personal credit. Now that is true. However, once that account is open established, most issuers, with some exceptions to be clear, but most issuers don't report that account to your personal credit report at all. Now, this can be a good or a bad thing depending on what your goals. Sean, why don't you explain some of the implications of many issuers not reporting business cards to one's personal credit report?
So first is that because it's not on your credit report, it's not going to build any credit history. So you're not going to have a, longer length of credit history or anything like that. And so if you're keeping, let's say it's a no annual fee business card open, you keep it open for the long run, you may view that as a negative. However, there's a couple of strong positives. Because the actual card, now the inquiry will show up on your report when you apply, of course. So you will receive that temporary ding. But the card itself will never be on the report for most issuers. So that new account isn't there, meaning it's not lowering your average age of accounts immediately. And it's not hurting your odds for getting more credit cards from other issuers. So there's no implications to your Chase 524 status because it's not on your report. So the other banks can't see it. Now, let's say I get a Chase card and then I go for another Chase card. Yes, of course, Chase could still see I got a business card from them, so they may be more hesitant to approve me for additional Chase cards. But for issuers outside of the one which you just got the business card from, it's not going to appear. And it also means if you do care about utilization at all, your utilization will not appear on your personal report, so you don't have to worry about that. The exception, of course, is like for pretty much all of the banks that don't report the business card, they make an exception that if you go in if your account is delinquent and you're not paying it off, then they will report that to your personal report.
Yes, I think those are very good points. I just want to expand on the 524 Chase rule that Sean talked about with respect to business cards. Now, being approved for a Chase business card requires that you be under 524, meaning that you don't have 5 or more new accounts in the last 24 months on your personal credit report. So that is a criterion for approval for a Chase business card. But once you get approved for that Chase business card, it doesn't even add to your 524 metric that Chase, even though, and it's really weird in my opinion, because Chase knows what business cards you have, but in terms of calculating 524, it simply looks at your personal credit report. Even if they know you have more like business cards, they don't count that against you. So you could be at 424, and then open like 4 Chase business cards after that, assuming you get approved, and you're still at 424.
Yeah, I think it's a really interesting thing because, yeah, as you said, they definitely know, but they just they just ignore it, I guess. But so
Yeah.
business cards, this is what makes them so powerful because the fact that they're not on your personal report means you can just get a lot more credit cards and a lot more sign up bonuses and a lot more perks
Yep.
without, hurting your velocity. I think. Let's
Okay.
move on to myth. Oh, sorry. Yeah.
Yeah, so the other myth I wanted to talk about is about closing cards. And some people believe closing credit cards is necessarily good for your credit score or it's necessarily bad for your credit score. I think the answer is more close to something like it depends. So remember, we talked about average age of accounts. Now, if you go out and close your, oldest 30-year-old credit card, will your credit score drop? Probably, because you just decreased your average age of accounts. But if you close like a fairly new account and you already had a lot of well-established accounts on your credit report, it probably won't even really drop your credit score. If anything, it might even increase your average age of accounts. That being said, if you need to close a credit card because of, you no longer feel like you should pay the annual fee, for example, or no longer makes sense to do so, consider downgrade options instead of closing. So why should we consider downgrading instead of closing? Sean, you want to kind of explain that?
Yeah, so if you downgrade the card, it's still considered the same line of credit that the bank has provided to you. So it's still considered the same credit card account. You just change the specific product that credit card account is under. So, for example, if I have a Chase Sapphire Reserve and I downgrade that to a Chase Freedom Unlimited, it's a different product, but because the initial credit account is the same account, it's still identical on my credit report. It's just Chase is charging me a different annual fee going from, $550 to nothing, and I'm just getting different perks and benefits. But that means you can stop paying the annual fee on a card you don't want while still getting the credit score benefits. Now, the ability to downgrade will depend on various card product lines and various card issuers. So it's not always going to work. You can't take an MX Platinum and downgrade it to a no annual fee card, for example. So it's going to depend on the specific one you're trying to do.
Yes. And I always think it's good to have like a solid foundation of some no annual fee cards early on in your credit journey. Because, just even if you don't end up using them, right, there's no cost keeping them open as no annual fee cards. So they just keep maturing your credit. Whereas if you kind of are stuck with some like high annual fee card as like one of your earlier cards, it may ding you a lot more to have to close them later. So just something to keep in mind. Okay, let's move on to the next myth, which is that the factors cited in an issuer's credit card application denial letter are the real reasons that you've been denied for the card. So, commonly you'll see something like, oh, you got denied for this card because you had too many inquiries in the last 24 months, too many accounts opened recently, or not long enough credit history. Honestly, most of these reasons are bogus, wouldn't you say?
Total. I think a lot of it is like just like a liability thing. They have to give some reason and they want it to be like official sounding. But a lot of these banks have like very specific internal rules. And they're not just going to go flat out tell you like, oh, we would only approve you if you had X many inquiries in this month or in this many months. And because you were this many over, that's why we didn't. Like, they're not going to be that specific. So just because you see something on the denial letter doesn't mean that it's like the actual real reason you got denied. It could be for a totally different reason.
Yeah.
And it all relates to the bank's like specific rules for applications on their credit cards.
Yeah, oftentimes it's just generic boilerplate language, frankly. Like, I've seen people get something like, you had too many accounts open last year, even though they had 0. Or like my dad, who has like a 30-something year credit history, will be like, age of credit history, not long enough, which kind of makes 0 sense in certain contexts. So, take it with a grain of salt and don't be afraid to ask for reconsideration. Even if you receive a letter with these reasons, they're just boilerplate language. They don't really mean anything.
Definitely. I totally agree. I think for the final myth here is that credit scores are the same. And this is something that so many people like, oh, I checked my credit score and I saw this, but it's there's no such thing as the credit score. There's different first of all, there's different models of scoring credit. There's Vantage score and there's FICO scoring. There's different models. Now, most people or most banks use like the FICO scoring model. But more importantly, and this is where I think like we get more of the nuances of it, there are three major credit agencies or credit bureaus in the United States. There's Experian, Equifax, and TransUnion. Now, what happens is each of these agencies collect information about you from your various credit accounts. And your credit score is just simply what these agencies store about you. And this is very important because when I receive a hard inquiry, for example, when I apply for a credit card, it's not like I receive an inquiry on my general credit score because there's no such thing as a general credit score or even a general credit report. I receive an inquiry usually to one of these specific agencies. So for example, if I apply for a Chase business card, usually I'll get a pull on my Experian credit report. But let's say I then go and apply for a Barclays credit card. Barclays usually pulls TransUnion. So Barclays is not going to see that report, that pull from Chase, because it's a different credit agency. The bank only sees what they get from the credit agency they pull. So if I receive inquiries from different credit agencies, the banks don't know about each other getting those inquiries. They're totally separate agencies. Now, some banks, like Capital One, notoriously pull multiple credit agencies simultaneously. However, for most of the banks, they only pull one credit agency. So they only see the information about you stored within that agency, which is very important for a variety of reasons. If I open a card that puts me past 524, but it's not reported to this specific agency yet, which I've had happen, by the way. I've had cards that just for some reason, like I had a Chase card for like 2 years that never reported to like my Equifax. And I used that to get approved for the Wyndham business card from Barclays because I was below the Barclays 624 rule, but only on that issuer.
Yes, I think Sean brings up really good points, and for like that are pretty relevant to like more advanced credit card applicants. Like there are times where I will strategically plan out applications based on like, oh, if issuer A only pulls, this bureau, but then issuer B only looks at a different bureau, and I might be able to apply for issuer A first. Issuer B won't see the inquiry from that application, but also, that application was so recent, it hasn't reported the new account to the second bureau as well, so they won't see it as well. That increases my chances of getting approved. So it could be helpful to bundle applications together if you study the patterns of which like issuers pull which bureaus and like how long they take to like add new accounts to your credit reports and stuff like that. There's a lot of information about this online that we're not going to go into detail about, but it could be useful for more advanced players that want to kind of bundle their applications together. Sean, have you tried these strategies?
Yeah, I mean, I've tried this like particularly with like Amex, where like Amex sometimes takes a while to report. And I've also like just especially with like the different types of like polls, I've definitely gamed that and gotten some perks. Like one perk, like pro tip for Capital One, usually you can freeze your Experian report, and so they won't actually pull that, but they'll pull the other two agencies, so it saves you a free inquiry. Doesn't always work, but just a pro tip there. There's a lot of these different various ways you can game the applications, and I think it's really important to look at, like, especially if you're doing like business cards, like what bank pulls what bureau, because if you can apply for cards that pull from like different agencies, then you can have a lot higher of a velocity than if they all pull from the same agency, because then they're going to go, why are you getting so many new accounts? Or like, why are you applying for credit so many times?
Yep, I think those are all really good points. So what are your thoughts about these credit card myths, or are you familiar with other credit card myths? Leave a comment down below if you have any. Also, if you enjoyed today's video, please consider liking it and subscribing to our channel, which is rapidly growing. We greatly appreciate your support. Also, if you are interested in applying for a credit card, please consider using one of our links in the description below. Using them greatly helps support the channel. Sean, finally, why don't you plug our Discord?
Yes, if you want to connect with an elite group of award travelers entirely for free and learn a ton, check out the Travel Lane Discord group at the link in the description or at the pinned comment below. Sherwin and I are in there. We can answer your questions. I promise you will learn a ton. Thank you so much for watching, and we will see you next week.